In the raising money arena, we have witnessed the rise of lending platforms, sometimes called marketplace lending. When lending platforms first appeared, they were referred to as P2P or peer-to-peer, as per the original intention. But that terminology is falling out of favour somewhat, because whilst the people doing the borrowing may well be individuals, the lending is being done mostly by institutional lenders. Players in this arena include Lending Club and Prosper from the US, and Funding Circle and Zopa, and several more from the UK. Much of the decision-making process on lending platforms is made using artificial intelligence, primarily in the form of machine learning algorithms, which perform advanced data analytics on prospective borrowers, making creditworthiness decisions on someone's capacity to afford a loan and the likelihood of not defaulting on the payments. It has been demonstrated that the machine learning algorithms are better at identifying lower risk borrowers than traditional methods using traditional data employed by the credit rating agencies who have been doing it for decades. The result being that many people have been able to access credit and pay it back successfully who the credit rating agencies would have categorized as couldn't or wouldn't. The term platform lending is important in both its parts. The lending part is self-explanatory. It is the platform part which has most significance for FinTech. A platform is an online marketplace bringing together buyers and sellers, consumers and producers, users and providers, and is a common feature in our everyday tech experience. Uber, the world's largest taxi company, owns no vehicles. Facebook, the world's most popular media provider, creates no content. Alibaba, the world's most valuable retailer, has no inventory. And Airbnb, the world's largest accommodation provider, owns no real estate. That's everyday tech, but it's no different in FinTech. Platforms are ubiquitous. In addition to the lending platforms, we have the crowdfunding platforms for raising private equity, where individual investors get direct access to startup projects. There are debt-based crowdfunding platforms where the idea is to borrow money. Leading examples of these in the United Kingdom are Assets Capital and Lending Works, Assets Capital being the first to introduce secured debt-based crowdfunding. Funding Circle and Zopa, mentioned earlier in platform lending, have a hand in this space also. And there is equity-based crowdfunding, where the idea is to sell some control or other rights in return for investors' money, with names such as Seedrs, Crowdcube and Syndicate Room being a few leading examples in the UK. Also very popular is reward-based crowdfunding, where the idea is to take investors' money with the promise of providing them with a product or service. Globally, the best known are probably the US platforms Kickstarter and Indiegogo. Closer to home, Crowdfunder would be one of the leading UK reward-based crowdfunding platforms. There are also donation-based crowdfunding platforms, where people make donations to what they perceive as worthy projects or causes. Names like GoFundMe in the US and Just Giving in the UK are two you may have heard of. Platforms are also the basis for the crypto equivalent of public equity. Traditionally, firms held initial public offerings in which they raised money by the selling of shares, issuing share certificates. Now that approach is complemented, indeed rivaled, by initial coin offerings on crypto exchanges, where coins and tokens are the securities issued instead of shares. And secondary trading in these tokens, etc., is facilitated by smart contracts executed on public blockchain-powered platforms such as Ethereum. Also known as DApps or distributed apps, smart contracts are essentially short computer programs or scripts with actions set to be triggered at certain times in the future according to predetermined conditions and agreements. The output of these smart contracts is recorded on the host blockchain for general authentication and verification. Available also potentially in the case of legal action. So, just as paytech is buzzing, the raising money arena is every bit as busy. Naming this area is a little more involved, because whilst we see the term credit tech in the FinTech vocabulary, this is about more than accessing credit. So I will use the term CapitalTech to capture it more completely. In the investment arena, we have witnessed the emergence of robo-advisors, robots, so to speak, offering financial advice. These robots are really machine learning algorithms accessed directly through apps, websites, or indirectly via third-party providers of investment services. US Robos, Wealthfront and Betterment are two of the world's largest. In the UK, the first to appear was Nutmeg, with Money Farm currently a leader in the UK market. Moneybox and Ticker are another two recognisable UK robos. Artificial intelligence, AI, in the form of machine learning, has taken this arena by storm, completely transforming the business model, directly reaching out to clients for the purpose of generating investment business. Robo-advisors bring investment and general savings opportunities to literally hundreds of millions of people across the world who otherwise could not access them. The inefficiency of traditional investment services, the people, paper, buildings, business model meant that an entire market of customers were simply not profitable enough to reach out to. Not so when you employ the data, software and server business model of FinTech, or the 3 A's of apps, APIs and analytics. Through the instruments and design of microfinance, many people of ordinary means can get a foot on the savings and investments ladder for the first time in the history of the industry. The same 3 A's underpin stock selection and portfolio management, and again have completely transformed the landscape of how things are done in the arena of fund management, in particular in the passive versus active approaches to fund management. The use of exchange-traded funds or ETFs and the associated low fees means the passive approach to this kind of investment is more affordable, more accessible, and by and large just as effective as the less affordable, less accessible, active managed approach. There is an amazing level of activity in this arena, as the AI approach is being adopted by new and existing players alike. This is InvestTech.